And with that, Ryan, I'll hand it over to you to briefly introduce what FairPlay is doing and what excites you about them.
Yeah, so thanks, Nick. Yeah, and glad to be here. And we met my partner Tom. Actually known Kareem for years, I think, from his old role at Zest. And so when Kareem had kind of floated this idea of what he's working on, we learned about it very early, and we were very excited right off the bat. I think there's a product that has really potentially transformative impact on financial services and on a number of different verticals within the financial services industry, including lending, marketing, kind of, and maybe outside of financial services too at some scale. I think one thing that really impressed us about this team was both Kareem's mastery of the subject matter, his connections, and his relationship to a lot of the key partners to help scale this business. And then there's also his co-founder, John's deep knowledge of machine learning, his incredible technical mind. And so we just had a tremendous amount of conviction here in this business really early. So I think we were the first investors in this company. This is one of our largest investments that we've made out of the current fund. We're very bullish on the growth. They've grown extremely quickly and built a lot in a very short period of time. So I'm excited for Kareem to share what he's built with the group.
Thank you, Ryan. Very kind of you. Hi, everybody. It's a pleasure to meet you. We're a small group. I'm going to run through some slides, but let's keep it informal. Please interrupt if you have questions, comments, etc. I'll try to move pretty quickly here since we are, I guess, running a bit behind schedule. Can everybody see this screen?
Yes, we can.
All right, terrific. Let me see if I can move this. Perfect. So as Ryan notes, my name is Kareem Saleh. I'm the founder and CEO of FairPlay. We are the world's first fairness as a service company. We are building fairness infrastructure for the internet. If you've been paying attention to the headlines lately, you know that algorithmic discrimination is everywhere. And even the most technologically sophisticated companies struggle to combat bias in their decisioning systems. Whether you're Amazon or Goldman or Uber or Facebook or United Health, these companies have all been subject to allegations that their decisioning systems discriminate against people of color, women, and other historically disadvantaged groups. And lenders are especially susceptible to algorithmic discrimination. That's because the data that they all use to build their marketing, underwriting, collections models better represent white males than they do historically disadvantaged groups like people of color and women. The tools that are commonly in use in financial services to detect and remediate bias, like Leave One Out and BizG, are extremely primitive. And fair lending regulations themselves are vague and subject to interpretation. There is no consistently applied definition of fairness, no consistently applied threshold to determine if a decision is fair or not. And so algorithmic discrimination is exploding all around us at a time when lenders face unprecedented scrutiny of their fairness practices. The new administration has made clear that after a hiatus, fair lending enforcement is going to be back in a very big way. Some of you who are paying attention to this issue under President Obama may recall that he levied very, very substantial fines against the likes of Ally, Citi, Toyota, Honda, all paid fines in the tens of millions of dollars over allegations that their credit scoring models discriminated against people of color. The K-shaped recovery coming out of the pandemic has pushed issues of economic inequality to the top of the national agenda. And frankly, whether it's the death of George Floyd or the Black Lives Matter movement, you've got consumer advocacy groups and other social advocacy organizations all asking whether financial institutions are doing their part to advance the cause of racial equity. Meanwhile, fair lending compliance remains stuck in the 20th century. Today, fair lending compliance is time-intensive, manual, and costly. It can take weeks or months to do a basic fair lending analysis. It requires armies of outside consultants and lawyers, and it's quite costly, often running into the hundreds of thousands of dollars for an engagement. And what's worse is that what passes for fair lending compliance today still leaves lenders with residual regulatory risk, because none of it actually makes a lender's lending practices any fairer. What passes for fair lending compliance today is mostly about using creative statistical and legal arguments to justify disparities in your decisioning systems. So it's time that fair lending compliance entered the 21st century, and we've built a tool, FairPlay, that does just that. We believe that fair lending compliance ought to be fast, rigorous, and cost-effective. And what's more, we think fair lending compliance ought to enhance your fairness practices, not just try to legitimate your discrimination. We think that done right, fair lending compliance can allow lenders to extend credit more safely, efficiently, and profitably to groups that they perhaps couldn't reach before. I'll tell you a little bit about how it works. Our tool starts with a fair lending analysis that is rigorous, fast, and free. We can assess a lender's loan portfolio for underwriting and pricing disparities within minutes. We apply the fairness metrics and thresholds that regulators use in exams. And before you pay us a penny, you get to review all of this analysis that you would have paid lawyers and consultancies tens or hundreds of thousands of dollars for, all with the push of a button. But we don't stop there. Our fairness optimizer applies the latest AI techniques to help lenders fine-tune their existing models for fairness, using their existing variables and data sets. And we document that we did all of that analysis so that financial institutions can provide their regulators with concrete evidence of the ways in which they have embedded fairness considerations into all of their automated decisions. But what I think is really cool is our second look functionality. Our second look functionality identifies credit-worthy borrowers that lenders previously rejected. These tend to be borrowers that are just below a lender's current approval thresholds. We run a nearest neighbors process to identify how these rejected borrowers actually resemble good credits on dimensions a lender might not have previously considered. And in the process, we offer lenders an opportunity to improve their profitability and enhance their fairness. What's really cool about Second Look is that it augments lenders' existing decisioning systems rather than replaces them. So lenders can get the benefit of this Second Look technology without having to disrupt a lot of internal technology or decisioning systems. How does it work? We apply some of the world's most advanced AI techniques, whether it's adversarial networks, generalized location models, optimal transport theory, kernel methods like support vector machines. We are constantly reviewing the latest and greatest mathematical developments in AI fairness and incorporating those techniques into our platform. And the result is that we think we've built the lending industry's most comprehensive fairness solution. As I said a little bit earlier, our tools identify whether a model is biased, and if so, why. We automatically generate fairer models that meet a lender's profitability objectives. We identify creditworthy applicants who fall just below a lender's standard approval thresholds, and we document all of that in ways that the regulators expect to see. And the result is that our tools help lenders transform their compliance function from a cost center into an engine for growth and goodwill. They can drive profitability and fairness, reduce regulatory risk, identify new creditworthy borrowers, strengthen their brand, and ultimately focus on what they do best, which is serving consumers with great financial products. I should add that the tool is extremely easy to implement and secure. Lenders can choose whether or not to host this tool in their environment or in ours. We partner with best-in-class cloud infrastructure providers who guarantee government-grade security. All data is kept on US servers. and you can consume the outputs of our tools into your existing workflows with a simple API call that can be implemented in hours. I should say a word about our team. I've been working on this problem of financial inclusion my entire career at the German Marshall Fund, at Softcard, at Zest Finance, and for several years in the Obama administration at the Overseas Private Investment Corporation and the State Department. My co-founder, John Merrill, is a PhD in AI. He was a student of Walter Rudin, who's commonly considered to be the godfather of pure mathematics. And he spent over a decade as a distinguished engineer at Google and Microsoft. Our head of product, Bianca Akula, is arguably one of the finest user experience designers of her generation, having worked at Facebook, Target, The Honest Company, and Quibi. And our SVP of data science, who manages our client engagements, John Piotrowski, has a master's in financial engineering from NYU and has developed credit models for Goldman Sachs and McKinsey. If there's one message I want to leave you with today, it's that fair lending compliance must evolve. Traditional fair lending compliance is heavily manual, takes a lot of time, and extremely costly. And as I said, it does nothing to enhance the fairness of a financial institution's lending practices. It merely attempts to justify past disparities by using clever statistical and legal arguments. FairPlay, by contrast, is free to try. It starts with a fair lending analysis that's rigorous, fast, and free. We search for fairer models if they exist. We do run a second look process on borrowers lenders said no to, but who resemble good credits. And we document all of that in the ways that the regulators expect to see. So if any of you know financial institutions who are seeking to bring their fair lending compliance and their fairness practices into the 21st century, please have them reach out and contact me at Kareem at fairplay.ai. Why don't I stop sharing now and see if folks have questions, thoughts, reactions, comments.
Great. Thanks so much, Kareem. That was wonderful. And we have a question right away. Larry, if you don't mind, how about you just tell us what your question is?
I love this question. So I'll just read it. Are regulators exploring similar approaches, or have they expressed interest in adopting your tools? What about plaintiffs' lawyers?
So sorry, my mic was off, so you did my job for me. Thank you.
Well, thanks very much for the question, Larry. Regulators are very, very interested in this subject. I don't know how closely you pay attention to the CFPB, but they've just put out a request for information a few days ago on the use of machine learning in credit underwriting. And these questions of bias are front and center in that request for information. The New York Department of Financial Services has also launched several investigations into insurance companies and lenders over allegations that their credit models or insurance models are discriminating against people of color and women. I'm told that there are 10 such investigations going on now by the New York Department of Financial Services. And it's funny that you mentioned plaintiffs' lawyers. Our first customer was actually a plaintiff's firm. They sued Facebook several years ago over allegations that Facebook's housing marketing algorithms were systematically not showing advertisements for housing to tenants of color. And as part of the lawsuit settlement, that plaintiff's firm gets to monitor Facebook's housing marketing algorithms for bias, and they use our tool to do that. There's another plaintiff's firm that I was speaking with just a few days ago that is has brought a lawsuit against Uber over allegations that the algorithm that Uber uses to fire drivers systematically discriminates against drivers of color. And that plaintiff's firm is also very interested in using our tool. So we're starting to see a lot of interest in this subject, not only from the regulators, but also some of the folks who enforce fair lending laws kind of at the civil level.
Great. Larry, does that cover your question? Anything else?
Yeah. I mean, I should have not limited myself to plaintiff lawyers. I can imagine defense lawyers also being very interested when they're being attacked by others for their practices. So it's sort of the same thing.
Yeah, I would imagine that once a plaintiff's attorney successfully prosecutes a case based on a fair play analysis, every defense firm will at least have to know how they would fare using our tool.
Yep. Great. Thank you.
Looks like we have another question here from Philip. Will FairPlay fall under regulation, and if so, which?
Yeah, of course, financial institutions are responsible for oversight of their third-party vendors. That is, to make sure that, the techniques and methodologies that they're using to comply with various regulations are legitimate. And so I expect that as more and more banks adopt our tool, that they will subject us to various third-party vendor management protocols. I'm happy to say that I maintain a very active and intensive dialogue with the regulators at the CFPB, the OCC, the Federal Reserve, and at the state level. And so we're very fortunate to be known by most of the regulatory agencies who would be interested in kind of the work that we're doing. And our customers can represent to those agencies that we kind of know what we're doing and be taken, be considered credible when they make those assertions.
Great. Got one last question here before we should move on from Jim Friess. Are you also looking at potential discrimination in credit scores from the traditional rating agencies? Great question.
Yeah, so it's funny. Thanks for the question, Jim. We've actually been contacted. I just gave a presentation to the Federal Reserve last week. And on the heels of that conversation, one of the major credit scoring agencies reached out to us to discuss a possible engagement. We also help lenders who use our tools assess the extent to which third-party credit scores are driving disparities in their models. And then we help them find ways to maintain the predictiveness of those scores while tuning down their disparity driving effect.
Fantastic. Well, unfortunately, Kareem, we are just about out of time today, but thank you so much for presenting, and thank you all for the wonderful questions. If you do want to get a hold of Kareem, you saw his email address. If you didn't catch it, well, he's around, and he's also available through me. So if you want to get a hold of him, I could be that conduit.
Kareem at FairPlay AI, we'd love to hear from you. Thank you for the excellent questions.
Wonderful. Thanks a lot, Kareem.